This is the Asia Trade. I'm Paul Allen in Sydney.
I'm Haidi Stroud-Watts. These are the top stories this hour. Asian stocks are set for a softer start to a week, featuring the Fed's preferred US inflation gauge as traders brace for what's shaping up as a volatile second half. Also ahead, China and the EU agree to hold talks on the bloc's plan to impose tariffs on electric vehicle imports. Plus, we hear exclusively from the CEO of Mitsubishi Heavy about plans for next-generation nuclear reactors and competing with Elon Musk's SpaceX.
Well, let's get to today's agenda. Going to be a busy week, Heidi, and a lot of election-focused material as well. There is, of course, another debate in the United Kingdom. Things not looking too good for Rishi Sunak at the moment, but we all knew that. It's going to be very interesting this week, though. The first US presidential debate, that crept up very fast, and Donald Trump says he's chosen a running mate, but in true showbiz style, we don't know who it is. They are going to be attending in Atlanta, so here are the names. Could be North Dakota's Governor Doug Burgum. They have a strong relationship. Ohio Senator J.D. Vance, of course, he's a famous novelist as well, and he's very young, 39. That might make things interesting. And the other possible contender for Trump's running mate, Florida Senator Marco Rubio. And if we cast our minds back to 2016, those two traded some fairly epic insults, but it's all forgotten now.
Be very interesting with this debate, right? Because, you know, so much of the sort of debate and criticism centering on the ages of these two candidates. So a very big focus will be on their performance, of course. And we know that these sort of debates tend to be quite perilous for the incumbent candidates. So we'll be watching that very closely. As you mentioned, of course, the political situation, uncertainty in the UK as well. Also, we're watching France, right? These new polls showing that the French National Rally continues to forge ahead of President Emmanuel Macron centrist bloc, continuing to cement that lead in opinion polls. We're just a week out before that snap parliamentary election there. So Marine Le Pen's far-right party seeing support at about 36% in this survey by L'Abbé published on Sunday. That's ahead of 27% for the left-wing New Popular Front Alliance and just 20% for Macron's movement as well. So we've seen that kind of outsized reaction, Paul, when it comes to some of the stock sectors that are seen to be impacted by any kind of massive policy shift. And this is really seeing, you know, voters putting a lot more trust in National Rally compared to other groups on how it would handle the economy, despite, of course, a lack of governing experience and an absence of kind of, you know, plans when it comes to funding as well.
Although perhaps in terms of risk, the National Rally has walked back its harsh rhetoric from a few years ago about European Union membership, its views on the Euro. So, I mean, if we're to take one positive away from this in terms of markets, it could potentially be that. But this taking on an extra sharpness as well, considering the EU getting into a trade dispute with China. The two sides agreeing to talk, so at least that's something. But we'll be keeping an eye on China as well early in the week, because the World Economic Forum kicks off on Tuesday, so-called Summer Davos. 1,600 delegates. Premier Li Qiang is going to be there on the opening day tomorrow.
We continue to watch the yen as well, of course, when it comes to some of these geopolitical concerns and geostrategic concerns on currency. We're getting a very early set of kind of verbal intervention, right? This is what we're hearing when it comes to the Ministry of Finance's Kanda saying that currency chief Masato Kanda speaking there, saying they're ready to intervene 20 hours a day if needed. They are not thinking of specific levels for intervention, but they're always ready to intervene if needed. They're in touch with their global peers when it comes to FX on a daily basis. They'd see no impact from the US FX report on Japan Forex policy. Remember last week we had the US adding Japan to that report when it comes to the watch list for what it's doing on the currency. Of course, so much of this is not down to currency manipulation. This is just down to pure rate differentials and the gap that we continue to see between the Bank of Japan and the Fed, right? But the bar really is much higher than ever when it comes to intervention and boosting the yen. Over the past 2 months, we've had the BOJ delivering 2 policy decisions that failed to really ignite yen bullishness. The Ministry of Finance authorising a record amount of direct Forex intervention as well. But yet, despite all of that, Paul, we continue to see upward momentum when it comes to dollar yen. So really convincing those yen bears to give it up will be tough until we see the MOF and BOJ perhaps kind of more aligned on the same page there. This is what we're seeing, though, across the rest of Asia as we get this week started. Set to kind of see a little bit of weakness as we get, of course, the risk coming from US CPI. The Fed's preferred gauge of inflation is what we get, and that will, of course, guide those bets on the outlook for global rates, not just in the US as well. But, of course, a big election week that we're watching as well. Sydney futures are looking a little bit softer there. We've got Chicago Nikkei futures looking more or less flat. Watching China as well when it comes to expectations out of some of Davos and perhaps some of the policy signals that we get there for the economy. S&P futures are looking just mildly positive and a bit more upside when it comes to trading in big tech. But this is kind of that crucial juncture, right, of positioning going into the second half.
Yeah, well, let's get back to that story we mentioned a minute ago. China and the European Union agreeing to talks on the bloc's plans to impose tariffs on electric vehicle imports. China correspondent Min Min Lo is in Hong Kong with the details. So, Min Min, the two sides talking. What are our expectations here?
Well, the fact that the two sides are talking suggests that there is room for maneuver and that there is intention from both sides to really prevent an escalation into a tariff war. And that was precisely what the German ministers were in China for over the past few days, really emphasizing that these tariffs are not meant to be punitive in nature. They are meant to compensate for these unfair advantages that Chinese EV makers enjoy in the form of subsidies from the government. And so over the weekend on Saturday, in fact, the Chinese Commerce Minister Wang Wentao had a conversation over video call with his European Union counterpart, and we heard the EC spokesperson saying that those initial talks had been candid and constructive, that talks will continue at all levels over the coming week, but that any expected outcome of this negotiation will have to address what he calls are injurious subsidies. And so some analysts have said that perhaps part of the solution could be to get Chinese companies to maybe invest in Europe, to build factories that pay European wages to European workers, and that could perhaps address some of the cost advantages and also the threat of taking jobs away from European workers.
We've also seen German ministers, including the Vice-Chancellor, landing in Beijing for that three-day visit at the end of the week. Have we seen any deliverables or announceables so far?
Yeah, I would say it's a bit of a mixed development over the weekend, because you would expect someone who is the German Vice-Chancellor, Robert Habeck, to meet with someone who is of a similar rank in China, and that would be Premier Li Qiang, the number 2 man in China. But that meeting didn't happen. Habeck himself expressed that he didn't know why that didn't work out, but he did get to meet with other senior Chinese officials, including the Commerce Minister Wang Wentao, the chair of the NDRC, which is China's macroeconomic arm of the government. And they had substantive talks, including on those tariffs. And again, you see this kind of push and pull dynamic from both sides. The Chinese side saying that, yes, they're willing to encourage Chinese companies to tap on the German market, but Germany, you have to step up your leadership here to get the EU to, quote, correct its wrong. And then you have the German Vice-Chancellor also managing expectations here, saying that this conflict will not be resolved in this trip, and that he cannot negotiate on behalf of the EU because those talks take a certain specific format. So hard to say what kind of, what is the room for maneuver here when it comes to those tariffs.
And then there is, of course, China's support for Russia. That sounds like a difficult conversation.
Yes, so China's support for Russia when it comes to the war in Ukraine, that was in focus as well. And the German Vice-Chancellor said that was, in fact, one of the biggest factors that is contributing to this deterioration of relations between China and Germany. He said that the EU will not have to reduce reliance on Chinese critical goods and raw materials if China were not supporting Russia so much. And then there was also talk about how China-Russian trade has increased by 40% last year, but nearly half of those had been in dual-use goods. So he hinted at possible implications of this, perhaps the need to relook at sanctions on Russia, possibly China. We don't know how that would go, but there are some warnings from Germany here about how China should manage its relations with Russia.
Bloomberg's China correspondent Min Min Lo there. Let's bring in Diana Messina, who's a Deputy Chief Economist at AMP. So, Diana, this is really a week and, in fact, a year that's been characterised by a lot of geopolitical and increasing trade risk. Do you think investors, economists are sort of ignoring those perils right now?
I think to some extent they are, and it looks like the market is more focused on the broader tech theme, particularly in the US. I mean, if you look at the US S&P 500, it's massively outperformed pretty much every other share market index. It's up by about 15% over the year to date. Compare that to the ASX 200, the Australian share market, it's only up by about 2% over the year to date. So investors are sort of placing more positive emphasis on that tech AI theme. NVIDIA became the largest company in the world by market cap last week. So there are definitely risks to the downside for share markets in the next few months, given all these geopolitical risks that you've touched on.
And you mentioned the sort of relentless focus on tech, on AI, on semis, on just purely NVIDIA. Does that seem almost, rate environment agnostic at this point?
A little bit, it does. It looks like investors are just focused on the sales potential earnings of these big companies, in particular NVIDIA, when we're talking about the AI theme. It's really hard to put a value on how much you think their future earnings are going to be, because no one really knows how much demand there's going to be for GPUs, chips, how much AI is going to be used in everyday life. I think everyone is just of the view that it's going to be involved in everyday business and in everyday personal life as well, which is why I think that NVIDIA's forward earnings can probably even look higher than they are right now. There have been a lot of comparisons to NVIDIA with Cisco and how Cisco crashed after the tech boom, but I think that there's more of a longer term positive story here for the AI sector.
Of course, Deanna, AI is notoriously power hungry. Is there a conversation to be had here around energy demand, energy prices, and what it could potentially mean for inflation?
It's definitely more of a medium, long-term theme for inflation. That was actually one of the questions that Michelle Bullock, the RBA governor, got asked at last week's post-meeting conference about her views around how the energy transition will really impact CPI. But for the short term, which is what markets really focus on, it's more around trying to get inflation back to the central bank's target in the next 6 to 12 months. And that energy transition story will be a factor that probably drives medium-term inflation higher over the next 5 to 10 years. But at the same time, you've got offsetting factors from a potential productivity boost related to AI. So I'm not actually sure what the medium-term impacts of that energy story are, but I think that for central banks, at least in the short term, they're purely focused on getting inflation back to target, which has been successful in some countries, but obviously in some countries like Australia, there is still concern that we have further to go to get inflation back down.
Let's move on to equally confusing ground and what's going to happen with the path of the yen, because we're seeing it weaken again towards that 160 level at the moment. And we just heard from Masato Kanda saying, well, look, Japan's ready to intervene on the yen 24 hours a day if needed. So the jawboning's starting up again. But given the experience of last time, Japan now on a watch list with the US, is intervention really a realistic prospect here, considering that the impact of it is not exactly enduring either?
To me, when I think about the main impacts on the currency, especially for a currency like yen or the US dollar, it's really about, is there going to be further safe haven demand for that type of currency? In the next few months, I'd probably say yes, just because of all those geopolitical tensions that are going on. So I do see some more upside for the yen, at least in the short term, from more safe haven demand, but also because I think that the Bank of Japan will raise interest rates further. Their inflation rates are increasing to levels that they're much more comfortable with. Wages growth has picked up quite a lot as well in Japan. So I see further upside for the yen, at least in the short term.
Deanna, when it comes to China, of course, we're still watching for, a bigger policy reaction, right, to support the economy. Do you see that as coming, or do you think, the markets have sort of given up, particularly when it comes to what more they can do about the structural issues with the property sector?
Well, to some extent, some of those small measures that policymakers in China were putting in place for housing, trying to get more lending growth in the economy, did help a little bit in terms of increasing Chinese shares over the past few months. So there has been some benefit from it. But at the same time, when you look at other economic data around the property sector, it still looks dismal. Property construction is down 30% relative to a year ago. There's quite low levels of lending, but in other terms, the Chinese economy in other sectors around industrial production, fixed asset investment, export growth is performing quite well. So you do have a very multi-speed economy in China. I think the policy measures in China will continue to be focused on the industrial sector and trying to enhance their manufacturing capabilities, more focused on exports and focusing on those exports that they know that are going to be in demand in the next few years around electric vehicles and solar panels, and as well as the renewable sector in general, which China seems to be doing quite well at. And that old story about strong consumer spending in China, I don't think is going to be a major driver of growth there in the next few years.
Deanna, I just want to finish up here in Australia. Of course, in a week's time, we're all getting a tax cut. How nice. Is there an inflation risk here, or are Aussie just going to spend it all on mortgages and energy bills?
Well, if you look at the Melbourne Institute consumer sentiment figures, about 80% of households said that they would save those tax cuts that are starting from the 1st of July. When I tried to do the math around how much consumers are getting from tax cuts, but also from some of the other measures like the energy rebate, and some of the state governments announced a few different measures as well in the budgets in the last few weeks, I compared that to how much extra households have been paying on their mortgage, if they have one, or for an average household. The fiscal drag from higher taxes or bracket creep, and also still elevated levels of inflation. And I don't see all of those positives from the tax cuts and the stimulus measures that are still quite small, offsetting enough of those other drags on the consumer. I think a lot of households will use that additional money to pay down debt or to put it in their offset account, or potentially just to save it as well, because the savings rate has been drawn down so much, and higher interest rates are an incentive to save right now. So I don't think that it's going to stoke a second round wave of inflation in Australia. I'm optimistic that we're going to get inflation down below what the RBA is forecasting right now. I think that the overall environment for the consumer is quite challenging, and those tax cuts are coming at a time that will help consumers rather than stoke inflationary pressures again.
All right, we'll have to leave it there. Deanna Musina, Deputy Chief Economist at AMP. Thanks, as always, for joining us. We have more ahead on the Age of Trade. This is Bloomberg.
Israeli Prime Minister Benjamin Netanyahu has repeated claims that the US is delaying arms shipments, but says he's hopeful the issue will soon be resolved. This comes with the Israeli Defense Minister headed for talks in Washington. Bloomberg editor Michael Heath joins us now with the details. And Mike, of course, this comes as we're looking ahead to the first of what we assume is several presidential debates. How is the issue of support for Israel and then the war in Gaza kind of playing in when it comes to domestic support in the US to continue contributing to that effort?
Yeah, it's an interesting issue, Haidi. I'll just start off with that first part about the weapons. Israeli media is actually reporting this morning, because the Biden administration was really quite bemused with what Prime Minister Netanyahu was saying. They weren't aware of any delay as such. What the local Israeli press is reporting is that the US had a fast-track mechanism going on early in the war when operations were at their most intense and Israel needed lots of weapons going through. Now, that expired in recent months, and so now it's a normal process for weapons to go, and the Prime Minister seems to have interpreted that as some sort of deliberate slowdown, which is why there was this sort of disconnect between the two sides on what was going on there. As to Biden and Trump, it's an interesting one, because Trump is obviously full bore in support of Israel. He's not particularly concerned about minority issues or Palestinian rights or any of these sorts of issues. It's all big picture politics, oil and power. Whereas Biden has a sort of a more difficult path that he needs to go through. He needs to try and bring that left-wing group, that sort of the coalition that's very, very upset about, and rightfully, about casualties in Gaza, about the Israeli government and its behaviour, and whether the US should be supporting any of this at all. I mean, they're part of his group, and so he has to sort of walk a line of the US must do this is our friend, but by the same token, we don't give them a blank check. We must sort of have safeguards around what's going on.
That's externally. Domestically within Israel, are we seeing maybe the emergence of a new political class here as well? And would they have any better ideas in terms of dealing with this very tough Palestine issue?
Very true, Paul. What we're seeing is there's a bit of disquiet among tech entrepreneurs and other business people about the way the government's running things at the moment in terms of their handling of the war, relationship with the US, all these sorts of issues, but also the state of the Israeli economy. And you have to remember that one of the strongest points that Benjamin Netanyahu's always had is that he's run a very, very good economy, which just gives him that ongoing support for people that, life is good, why change? And things are obviously much different when you're in a wartime scenario. But by the same token, these groups sort of feel that he's become beholden to the settlers and the religious parties as well, which is problematic in terms of trying to secure some sort of peace or some sort of deal or anything like that. So they have a lot of very, very good points. The problem is that Netanyahu, in a sense, is a strongman, a populist almost within a democratic context, and these guys are the elite. And so, in a sense, the ability to paint them as people who are opposed to Israel's national interests, which he sees himself as defending, he often sort of seems to conflate his political interests with the national interests. But in general, I think he'd be very, very comfortable politically in being able to take these guys on if they ever did do anything. They'd be better off working behind the scenes to try to support the opposition. The other thing is that Israel's electorate is so polarised. They had 5 elections in about 2 or 3 years. It didn't really bring a majority government, so whether that would change now is really questionable too.
And it is that sort of strongman projection that we saw in the most recent interview where he directly rejected the idea that a ceasefire would lead to the end of the war, right? How does he see the end of operations or a tapering of operations?
Yeah, he sort of let the cat out of the bag, didn't he? In saying, because this was Hamas's sort of point of view that they've been trying to fudge the language that there'd be a ceasefire and then the US wants negotiations to end the war. Netanyahu's obviously said we prosecute it through to the end. The idea was to sort of not talk about the next stage, and him saying that they'd definitely go back and finish it off. Hamas has already sort of come out and said, we'll see, this is why we're not negotiating with them, because they'll just come back and attack us anyway, so why would we release the hostages? That's triggered a really, really disappointed response from the families of the hostages, the 120-odd hostages there, obviously. And Netanyahu has since put out a statement saying, no, he still wants to get the hostages out, and he's sort of trying to backtrack on that. But I think, honesty sort of came forth there, and I think everyone suspected as much anyway.
All right, Bloomberg editor Michael Heath there. We have more ahead on the Asia trade. This is Bloomberg. Let's take a quick look at foreign exchange around the region and the world at the moment. We've got the yen continuing to weaken at the moment, and this is despite remarks just a few minutes ago from Japan's Masato Kanda saying that the Ministry of Finance remains ready to intervene 24 hours a day if needed. Markets didn't care. The yen still 159.82. Keeping an eye on the yuan as well. We had a stronger than expected fix on Friday. The yuan hovering around its lowest level since November, getting close to the weekend of its trading band as well. The euro 106.93 at the backdrop of election risk. And a quick programming note on that topic. Less than 2 weeks until Britain's general election. UK Business and Trade Secretary and the Shadow Trade Secretary joining us live in a televised debate.
This is the Asia Trade. We're about 30 minutes away from the major market opens across the region. This is how we're setting up. A little bit of trepidation as we get into a week that has a couple of key factors that we're watching, including, of course, the Fed's preferred gauge of inflation that will really kind of set expectations when it comes to the outlook for global interest rates, not just in the US, of course. We're seeing equity futures largely pointed to losses across the region. Australia, Japan, Hong Kong all looking a little bit softer ahead of the market open this Monday morning. We're seeing a little bit more steadiness when it comes to contracts for US futures there in the early part of Asia. We had S&P 500 in the proper session slipping on Friday. We had a large options expiry, but of course front and center continues to be the strength of that tech trade, Paul.
Well, foreign investors are continuing to be pessimistic about Japanese stocks after a record rally that took the country's shares much higher. Firms such as Citi and Aberdeen are selling Japanese equities due to worries over corporate governance reforms and uncertainty over the BOJ's monetary policy. Bloomberg's Asia equities reporter Winnie Su joins us now with more. So, Winnie, why are Japanese equities so unpopular now with foreign investors? That's quite the turnaround.
Yeah, so we're actually hearing that foreign investors are seeing some of the headwinds, especially near-term headwinds ahead for Japanese stocks. And we saw just last week that foreign investors have been selling for 4 consecutive weeks. And that's actually the longest selling streak since September. So the foreign flow was actually one of the big drivers that led Nikkei to hit its record high earlier this year. But now we're seeing that trend kind of turning around, and the extreme weakness of the yen is actually weighing on Japanese stocks as well. As you see, that starts to hurt domestic demand, and also foreign investors who are buying Japanese stocks with their US dollars, that's going to hurt their returns as well. And that extreme weakness also might prompt authorities to come in to intervene the FX market. So that kind of currency volatility is something that investors are watching for Japanese stocks at the time being. And also we've got the Bank of Japan's uncertainty. Just earlier in the month, we saw that the Bank of Japan unclear about what they're actually going to do, saying that they're going to announce the more specific plans around the reduction of bond purchases in July. So we saw financial stocks actually falling after that announcement, and that is continuing to weigh on the Japanese stocks. So other regions are actually looking more attractive when it comes to the Asian portfolio. Some of the investors are saying that they're taking profit from Japanese stocks and putting their money into, for example, Chinese stocks that still have low valuation, and Indian stocks that might continue to see some policy to come in to support the stock market.
There are a lot of long-term convictions when it comes to Japan, right? A lot of the corporate governance hopes, the policy normalization from the Bank of Japan, these are longer-term stories. So could we see a comeback at some point towards the year end or beyond?
Right, so most of the investors that we talk to are actually still quite positive when it comes to the longer-term outlook for Japanese stocks. The Bank of Japan survey last week showed that about 30% of the fund managers they surveyed see the Japanese stocks already have peaked this year. However, JP Morgan last week had a report out saying that they're seeing the Nikkei potentially reach 42,000 by end of the year, which is going to be its fresh new record in that sense. And they're citing that some of the factors to push the Japanese stocks out of the current range bond situation, and that includes less of the uncertainty around the Bank of Japan's policy, and also the yield differentials between U.S. and Japan to narrow, so that would help the extreme weakness of the yen to kind of appreciate, and that would also be a tailwind for Japanese stocks. So overall, the corporate story is still there, and the people are still expecting their earnings growth to come through the price hikes to be able to help with the revenues of Japanese companies. So in general, we're seeing that once that kind of current headwinds is over, potentially Japanese stocks will continue to rise for the rest of the year.
The role of the yen here, Winnie, is an interesting one, though, right? Because we've got it near 160 at the moment. There's a pretty awful time for profit-taking if you're a foreign investor, but pretty good time to buy. If the yen does strengthen, could we potentially see profit-taking?
So when it comes to Japanese stocks, yes, we are already seeing some level of profit taking. We talked to Aberdeen, which that actually told us that they've been taking profits from Japanese stocks and rotating that money back into some of the other regions that have been underperforming. So while we have already seen some level of profit taking at this point, investors are telling us that the yen is unlikely to weaken past 160, as we expect that the government most likely will step in again to support the currency. So the degree of profit taking from this point is supposed to be relatively limited, but investors are still quite hesitant to step into the Japanese market at this point, just given the current volatility around the currency. So we're actually hearing that foreign investors, especially global investors that invest in other currencies into the Japanese market, are taking a wait-and-see mode to see if the currency is actually going to stabilize around 150 to 160 level.
All right, Asia equities reporter Winnie Su there in Tokyo. Australia's third largest pension fund, Aware Super, is hunting among global real estate assets as it looks to build on its strong investment results. Its CIO says they are looking for distress in the hopes of finding really attractive prices. Bloomberg superannuation and pension funds correspondent Amy Bainbridge joins us now from Melbourne. And Amy, in terms of looking for distress, I can think of one very large market where there's plenty of distressed assets. Is Aware Super looking at China, or is that not exactly what they mean?
Not exactly, Paul. Look, they have said that they are looking globally for these opportunities. It must be said that, I mean, this time last year we were talking to a number of Australian pension funds that were writing down their office property assets by as much as 20%. So it really shows now that the tide appears to be turning. Damien Graham, the CIO of Aware Super, says that there's a much better price discovery than there once was. And Aware Super, of course, is one of the top funds that have opened up a London office. So they're going to be using that base to be looking for deals across Europe. It must be said that they are looking, though, in the top tier of the market for property, and office property in particular, for those signs of distress. The lower grade property does still seem to be pretty unattractive. Aware Super, compared with other pension funds, has around 6% of its total portfolio to property more broadly. Now, within that asset class, that asset allocation, about 20% of that is of office. So they don't currently have a huge amount, which is why they're looking to build out that and to see whether some of those signs are now coming into the market and there could be some good deals down the pipeline, although pricing hasn't quite adjusted yet, according to Graham, Paul.
Yeah, it feels a little bit like this is their wish list, right? They would want to see more dislocation of pricing before these opportunities actually materialise.
Yeah, absolutely. I think that's definitely what they're looking at. There's more price discovery, as they say, but those opportunities aren't right on the doorstep just yet. So there needs to be a little bit more coming through the system before they see. But I mean, you can walk around any city really and look at the vacancy rates, and Melbourne, where I am, is one of those where you can still see some quite large office blocks that appear to have very low tenancy. So there's a fair bit of complication in the market at the moment in terms of what you're looking for and whether you want to look at the B and C grade offices, which of course will require some sort of renovation in many cases to make them more profitable for investors. So absolutely a wish list, but very interesting that one of the biggest funds is at least now looking here for opportunities as those prices start to become more apparent to the large investors.
Our Bloomberg Superannuation and Pension Funds correspondent Amy Bainbridge there in Melbourne. Taking a look at some of the headlines when it comes to the bouts of extreme weather events that we've seen over the weekend. Saudi authorities say more than 1,300 people have now died during this year's Hajj pilgrimage as the kingdom faces extreme high temperatures. The Saudi health minister says most of the victims were what he called unauthorised pilgrims who walked long distances in the heat to perform the rituals. Almost 700 of the dead are from Egypt. Speaking on state-owned TV, the minister said another 95 people were being treated in hospitals. The US Mid-Atlantic region is struggling under an extended heat wave, with temperatures soaring from New York to Washington. New York Central Park touched 33 degrees Celsius, while temperatures at Reagan National Airport outside Washington tied a record set in 1988. More extreme weather may be on the way, with forecasts for severe thunderstorms and possible tornadoes. More than 40 people have died after heavy rains and floods hit regions of China. State media say 6 people previously reported missing after a landslide in Fujian province have been confirmed dead. A landslide in Hunan province also killed 5 people. President Xi Jinping has called for all-out efforts to address the flooding and to assist affected residents.
Okay, let's take a check on commodities at the moment. We've got the oil price backing off a little bit. Oil down for a second session. Traders weighing geopolitical developments in the Middle East. The outlook for summer demand as well. Israel, of course, saying it would soon end the intense stage of fighting in Gaza. So a little bit of softness to crude prices there. Copper, meanwhile, continues to get pulled in 2 directions. We do have bullish hedge fund managers seeing future shortages in that material. It is, of course, critical to the renewable energy story, the AI story as well. However, Chinese buyers missing in action right now. They're rather gloomy on the outlook at the moment, but we've still got copper near record highs. Iron ore prices also backing off a little, still above $100 a tonne though, 104.75 for futures traded out of Singapore. More to come on the Asia trade. This is Bloomberg. All right, time now for Japan Ahead. Some stories we're watching today. The Nikkei is reporting that Yuriko Koike is leading polling for Tokyo's gubernatorial race. Koike is vying for her 3rd term to lead the capital, which makes up more than 20% of Japan's economy. Meanwhile, a Kyodo News poll says a little over 10% of respondents want Japanese Prime Minister Fumio Kishida to win the ruling party's leadership race in September and continue serving as premier. 10%, that's not much. The survey also showed approval rating for Kishida's cabinet falling to 22%. Kishida has struggled to appease public anger over his Liberal Democratic Party's slush fund scandal. And Citigroup, Aberdeen, they are among firms that have turned more pessimistic towards Japanese equities as the outlook for corporate governance reform and BOJ monetary policy makes things look rather uncertain, Heidi.
Well, Japanese markets, Paul, opening, of course, at the top of the next hour, just about 15 minutes away. Watching the yen very keenly, but despite the sort of early volley of verbal intervention that we heard from Masato Kanda, the currency chief, the bar is still pretty high when it comes to further escalation for intervention in the yen, given, of course, a limited payoff, as well as what we've seen from 2 policy decisions that have really failed to excite yen bulls from the BOJ, that record amount of direct Forex intervention as well that we've seen. Still a lot of upward momentum for dollar yen. We're looking pretty muted across equity market opens across the region. Well, Bloomberg Intelligence says SoftBank founder Masayoshi Son's enthusiasm about artificial superintelligence might face regulatory hurdles. It comes after Son laid out some of his most grandiose plans yet on Friday. Some experts believe could pose an existential risk to humanity. Bloomberg Technology reporter Min Jun Lee joins us from Tokyo. So this is such a fascinating story. So artificial superintelligence, what do we know about this? What's Masa thinking here?
Right. Yeah, although the concept is not anything new, this is the first time Son has really promoted this idea and declared it his new passion, and that he said all of his attention is now focused around realizing this artificial superintelligence, which Son says will be 10,000 times smarter than humans and will also have emotions. And he did also say ARM will play a central role in this, and that SoftBank will seek other partner companies to make this super machine intelligence a reality in 10 years. This will naturally involve new big investments. So whether it can be realized or not is something we need to see, but at least some exciting things could be in the making. So, yeah.
Yeah, exciting. I think this is what Elon Musk meant when he talked about summoning the demon. But if we just step back from philosophical questions for a moment, what did Massa have to say about shareholder returns and share buybacks?
Right, a very important point. But whether it be share buybacks or share split or dividend payouts or even on the matter of possibly taking the company private, Massa Son did not provide a clear yes or no to any of these possibilities. But he did clearly say that all of these are of little importance to him, that these are minor details in running SoftBank because everything is now going to be about pursuing artificial superintelligence. So we'll have to see how investors react today after a 3% share price drop on Friday.
All right, Bloomberg technology reporter Minjong Lee there. All right, the latest from the corporate front. Australian supermarkets, including Woolworths and Coles, will face a potential multi-million-dollar fine or fines for anti-competitive behaviour under new regulations. That's amid the government crackdown on unfair prices and the rising cost of living. The new measures follow a review of the industry's code of conduct, which found that large supermarkets hold too much power over suppliers and farmers. Chinese builder Kaisa is set to begin presenting a plan to restructure its debt as it faces a winding up hearing in Hong Kong. Proceedings begin on Monday. That's about 11 months since creditors filed a petition to liquidate the developer. Kaisa defaulted on onshore bond payments in late 2021. The three other Chinese builders face similar wind-up hearings in Hong Kong this week. US prosecutors have recommended to senior Justice Department officials that Boeing face criminal charges for violating a settlement related to two fatal crashes. This is according to Reuters, citing two people familiar with the matter. The criminal charges DOJ officials are considering weren't specified and could extend beyond the original 2021 fraud conspiracy charge. All right, let's take a look at Paladin. This is an Australian-listed uranium miner, got a market cap of just under 4 billion Aussie dollars, in a trading halt ahead of the open at the top of the hour at the moment. We don't have a huge amount of detail on this, but a statement saying this trading halt is due to a potential acquisition, so Paladin shares won't be trading at the top of the hour. Paladin mines uranium in Australia, and I guess connected to this, Heidi, we are having a debate in Australia at the moment about the possibility of developing nuclear energy. It does have a rather political tone to it, and even if it happens, it could be 20 years before we see any reactors up and running.
Yeah, it's always a sensitive topic, right? But certainly that debate is sort of at fever pitch at the moment here in Australia. Fever pitch is also what we're seeing when it comes to debate over where the yen goes and, of course, where the BOJ goes from here. We do have the summary of opinions from the latest meeting. That is, of course, the June meeting, where we see one BOJ member saying to adjust the degree of easing if the price trend continues to rise, also saying the need to mull more adjustment of easing measures. Another board member saying that the upside risks are emerging when it comes to inflation. We have seen Japan's inflation accelerating, backing the case for a BOJ rate hike. The most recent readings in May, we saw consumer prices stripping out fresh food rising 2.5%, really on the back of rising energy costs. So this does back the case for the Bank of Japan to consider a rate hike in the coming months. Some of that data is still, though, below the consensus when it comes to the expectations of where it sits above or just above the Bank of Japan's 2% target for a 26-month. And the big question is, of course, is with the volatility in energy prices in particular, almost 15% jump in electricity prices, if that basket changes, can that 2% plus inflation target be sustained by the data that comes in? We have had a couple of months of deceleration there, so it's still, you know, a big question mark as to the timing of that rate hike. Yeah,
definitely. When you start peeling the layers of the onion of the Japanese inflation story, it becomes increasingly less convincing. These the summaries of opinion also very timely because they are from the June meeting. The minutes that we had last week were somewhat dated, so we're getting a much better idea of the BOJ's thinking thinking here at the moment. So upside risks are emerging for inflation, rate hike, all about timing. But here the currency market barely flinching. We've got the yen just below 160 at the moment. And we also heard from Japan's Masato Kanda today talking about more jawboning the yen again, about these excessive FX moves. Says they're watching 24 hours a day, ready to intervene if needed. But Haidi, one does wonder if the picture's changed a little since then. All the benefits of the previous intervention have faded, and now the US is watching as well.
Yeah, we had stronger than expected US PMI data, that reluctance of the BOJ to provide much of a detailed plan around the cutting of bond purchases. None of this is really helping when it comes to the momentum that we continue to see when it comes to dollar yen. Take a look at US futures at the moment. We're looking a little bit more positive compared to, of course, the lackluster picture across Asia, but that sort of picks up on the relentless AI rally that we continue to see there. S&P futures, Nasdaq futures all looking in the green there. Dow Jones futures looking a little bit softer there. But we have really seen the global value trade just getting absolutely crushed amidst the AI craze that continued in June, and continuing to look at further downside for some of those small caps as well. Well, the market opens in Sydney, Seoul and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens and polls. We'll be looking at this summary of opinions from the Bank of Japan from its most recent meeting. And, a lot of talk about, yes, there is encouragement that the virtuous cycle of inflation and prices and wages is developing, but there's a lot of uncertainty. Underlying inflation is still not at 2%. The nominal wage growth rate, inflation expectations, a lot of the other risks of those inflation components of the basket could mean that that may not be sustained.
Well, the yen not buying it either. We're just getting weaker and weaker, 159.91 for the yen at the moment. But a lot of political risk out there this week as well. We're going to have an election in France, debates in the UK, and a debate in the US as well, where we'll learn who former President Trump's running mate is. So going to be an interesting week on that front also.
Yeah, he says he's decided, but he's maintaining the intrigue when it comes to that one, right? Let's get you straight to the market open. Of course, we had the currency chief in Japan, Masato Kanda, coming out bright and early this morning with that volley of verbal intervention, saying they stand ready to act 24 hours a day. The yen isn't really buying it, though, so this is what we're seeing when it comes to that, pretty much that 160 level when it comes to dollar yen. The greenback is largely unmoved this morning. We are seeing a little bit of downside as we get into the start of trading across the Nikkei 225, off of about 0.25%. There is some suggestion that some of these major funds and major institutional investors might be losing a little bit of patience with this Japan rally. We're seeing the likes of Citi, for example, staging a bit of a pullback and seeing potentially at least this leg of the Japanese equities rally as being over. Some of the currency issues are really at play there as well. Switching out the board to take a look at how we're trading in Korea. This is a picture as we get into the open for the Kospi and the Kosdaq there, both seeing a little bit of weakness. The broader Kospi down by about 0.4%. We're also watching really broader currency weakness across the region. It's not just the yen, of course. We're seeing a number of Asian currencies either at or very close to their record lows against the dollar. A lot of that action is in across emerging markets in that space. So watching out for intervention risk, not just from the Ministry of Finance, Paul, but the likes of the Philippines, Indonesia are worth a watch too, given the levels that we're seeing their currencies at.
Yeah, let's take a look at how we're trading here in Australia. We're just about a minute and a half into the session. A staggered open, of course, alphabetical order, so hard to get a read on things. We're seeing a few stocks in positive territory. However, a number of banks doing reasonably well. AGL Energy among the top performers at the moment, but we'll get a better read on things in a few minutes' time. Not a lot of change to the Aussie there, but we've got yields continuing to back off a little. The 10-year now 4.25.16. 16 in the early going of the Tokyo session. And on that note, let's get a bit more market insight now with Thomas Tor, head of APAC iShares investment strategy at BlackRock. And Thomas, I want to start off with US Treasuries if I can. We've got foreign flows increasing, signs of a cooling labour market, possibly cooler inflation in the US as well. What are you anticipating for bonds in the second half?
Yeah, morning, and thanks for having me. So in terms of the fixed income market, clearly a lot of interesting things happening. I think one of the main trends that we've been seeing this year is not as much volatility in fixed income, particularly with ETF flows. Last year we were very much driven by rates volatility, inflation's volatility, and we saw investors kind of moving up and down the duration curve, moving from 20 plus years into short duration. But the overall trend really was short duration. I think as we move into the second half of this year, clearly there's a lot of risks in the market, but what we're starting to see investors looking at is more kind of in the middle of the belly of the curve, 3 to 7 years. We're starting to see a little bit more interest in taking duration risk. To some extent, a little bit of this cash coming out of money market mutual funds where, we're still at or near all-time highs there. So I think investors are looking for a little bit more duration, a little bit more yield, and an anticipation of the possibility of a rate cut from the Fed in September.
Yeah, in terms of that, markets are suggesting that maybe Fed policy's not all that restrictive. There's some debate as to where the neutral rate is as well. And are there some risks to the inflation story as well? Because of course we've got an election coming up in November, and neither candidate particularly shy about their spending plans or running large deficits. Can you see a scenario where inflation makes a comeback in 2025?
Yeah, and that's kind of the rhetoric that we've been talking about all year, is that, obviously higher for longer. Everyone's kind of gotten on board with that now. The expectations, as everyone knows, 6 rate cuts to 1, maybe 2 this year. It seems like we might get one in September, and that will be it for the year. It's kind of difficult to envisage a rate cutting cycle during a U.S. election month or a couple of months. And so, yes, I think, inflation is going to be here for a while. We're not really near a 2% target. And as you said, we have a lot of risks on the table as well. So I think probably we get one cut this year, and then, who knows for next year. Maybe I don't think the Fed will go back to a rate hiking cycle, but we're certainly not going to get one of these large rate cutting cycles that we've seen in the past.
When you take a look at the story of US equity exceptionalism, underlying, we're seeing one of the biggest dislocations between market performance and breadth in, I think, about 30 years, according to Bloomberg intelligence data. So going forward, do you see that further severity of that dislocation? Will we see better evidence of breadth across this market?
I think probably the latter. So, I mean, it's obviously hard to call when that disparity is going to start to narrow. But as you said, I think investors are starting to look now and seeing, okay, on the one hand, when you look at tech and quality and some of those mega cap names, the valuations haven't really gone up significantly because the earnings growth has been there. But I think the issue here is the expectations for forward earnings keep going up and up and up. And so, we're already starting to see signs that there is a little bit of a pickup in the rest of the market in terms of earnings growth. And on the other hand, investors looking at risks on the horizon, particularly U.S. election, and thinking, maybe it's now the time to start to allocate to some of the laggards in the market. One, because of the pickup in the pickup in earnings growth or expected earnings growth, and 2, just because things are a little bit frothy in that tech sector and maybe taking a little bit of risk, a little bit of beta out of the portfolio moving into the second half of the year. So yeah, I think that's what we're probably going to start to see in the equity market.
It's really interesting, maybe a little bit perplexing to me, that we're seeing this, as you point out, this reversal of the year-to-date trends, right? Some major investors seemingly losing patience with Japan. We're seeing flows back into China. Is this sort of supported by evidence, given that, that the longer-term bull story for Japan, one assumes, is still intact? The longer-term concerns over China's growth story haven't changed either.
Yeah, I mean, this is we have seen a little bit of that at the margin in terms of ETF flows. A minimal amount coming out of Japan and rotating into China. More in May. Over the last couple of weeks, actually, we've been seeing some outflows in China. So I think you will continue to see these tactical rotations, particularly when it comes to China, because we see China as a tactical market for the next couple of years, because the underlying issues are still there, but on the other hand, valuations are very appealing, and foreign investors are very much underweight. So, one of the biggest trends we've seen over the last couple of years, and has really extrapolated this year, has been the use of emerging markets ex-China as a benchmark, and that's something that we continue to see inflows. We've seen about $4 billion into that ETF this year, $14 billion over the last few years. So I think investors will continue to buy emerging markets ex-China, similar to what we saw in 2001 with Asia ex-Japan, and then dial up and dial down tactical risk in China. I'm not sure that's the point now, but certainly investors are going to continue to trade that tactically. And when it comes to Japan, we said a couple months ago, maybe the end of phase one of the structural bull market is kind of peaking in terms of putting on beta index type of risk, Nikkei topics, and now is kind of the time to move into phase two, which is more, number one, picking up some of the underweights that we're seeing, and number two, moving more granular into active funds, value, and also high dividend. And I think that's going to be the next phase for us over the next couple of years.
Thomas, how are you approaching Japan at the moment? Because we're seeing selling resume on the Nikkei today. We're off about 0.25%, but we've seen 4 consecutive weeks now of selling from foreign buyers. Are you among them?
Me personally, I am not. As a firm, I would say we're still very much in the camp of structural bull market in Japan. Clearly there's a lot for the market to digest when it comes to the BOJ and rates and inflation and how things are going to play out moving forward. And obviously we had a huge rise in the index over the last year. So I think this is kind of a reset period. You will start to see some shifts at the margin from shorter term tactical players, but I think most investors are still in the longer term structural bull camp. And as I mentioned before, I think this is number one, an opportunity to pick up some of those underweights, because we still think foreign investors are underweight. And number two, look at sectors and active funds which are going to outperform. And then finally, Japan as a value driven market gives a nice diversification tilt to some of those portfolios which are very, very heavily tilted towards growth at the moment.
And Thomas, what's your position on the yen now? Do you see further weakness here?
Yeah, up here at 160 on US dollar JPY, this is clearly where we saw some intervention not that long ago. And interesting to see that actually with US 2-year and 10-year yields moving lower, JPY has continued to depreciate. So I think to some extent the market is kind of challenging the MOF at the moment. Let's see if they actually intervene again. I think from our perspective and the expectation that we have in terms of BOJ raising interest rates this year, now would be a good point to actually take positions in Japan that are non-hedged, i.e. Taking a longer position in JPY, because I think we might continue to see a little bit of upside on US dollar JPY, but I think the longer term trend is going to be more towards the 140 range.
Thomas, really great to have you with us. Thomas Toa, head of APAC investment strategy at BlackRock. More ahead on the Asia trade. This is Bloomberg.
China and the European Union have agreed to talks on the bloc's plans to impose tariffs on electric vehicle imports. Our China correspondent Min Min Lo is in Hong Kong with the details. So Min Min, talking, that's positive. What can we expect here?
Well, there's no timetable for this talk for now, but we know that a deadline is coming up on July 4th. That's the provisional tariffs that will kick in then. It's unlikely that any outcomes could be decided before then, but of course the final tariffs will only be decided in November, and until then, Beijing is expected to continue negotiations with the European Union. So on Saturday, we see the Chinese Commerce Minister Wang Wentao having a conversation over video call with the European Union Trade Commissioner, and the European Commission spokesperson said that that went well. It was candid and substantive. He said that talks will continue in the coming weeks, but any expected outcome will have to address what he calls our injurious subsidies. And again, that was also what the German ministers were in China for over the last couple of days. The German Vice Chancellor really emphasizing that these tariffs are not meant to be punitive in nature. They're meant to be compensatory to make up for those unfair advantage that Chinese EV makers enjoy from their government.
We also saw the German ministers, including the Vice Chancellor, arriving in Beijing over the weekend. Have we seen any outcomes so far?
Yes, so the two sides have agreed on energy cooperation, on ways to accelerate the green transition, to cooperate when it comes to smart grids and so on. But again, those tariffs was a big part of the agenda. And you also would have expected someone who is of the Vice Chancellor rank to meet with someone of a similar rank in China, and that would be Premier Li Qiang, the number 2 man in China. But that meeting, which was widely expected, it didn't happen. And so the German Vice Chancellor said he didn't know why that didn't work out, but he did get to meet with other senior Chinese officials, including the Commerce Minister, as well as the chair of the NDRC, the National Development Reform Commission, which is the macroeconomic planner of China. And they did have substantive talks again about those tariffs. The Chinese officials saying that China is willing to get Chinese companies to tap on the German market, but Germany will really have to step up its leadership over the EU to get it to, quote, correct its wrong. And the German Vice Chancellor also managing expectations. They're saying that this conflict cannot be resolved on his trip, and he cannot negotiate on behalf of the EU.
Min Min, China's support for Russia was also in focus. What's the tenor of that conversation?
Well, the German Vice Chancellor said that China's support for Russia is, in fact, one of the biggest factors that is contributing to the deterioration of relations. He said that the EU would not have to reduce reliance on China's critical goods and raw materials if China were not supporting Russia when it comes to the war in Ukraine. And he pointed out that China-Russia trade has increased by 40% last year, but nearly half of those were in dual-use equipment that could end up on the battlefield. And so he hinted at potential implications of that, perhaps a need to relook at sanctions. And this conversation really came up because of Chinese complaints about how Chinese investments are getting more difficult when it comes to the tech sector in Germany, and how there are growing restrictions when it comes to Chinese companies when it comes to exports of dual-use goods to China as well.
Bloomberg's China correspondent Min Min Lo there. Well, Israeli Prime Minister Benjamin Netanyahu has repeated claims that the US is delaying arms shipments, but says he's hopeful the issue will soon be resolved. It comes as the Israeli Defense Minister heads for talks in Washington. Bloomberg editor Michael Heath joins us now with the details. So President Biden has perhaps a different view on this.
Yeah, so it's an interesting disconnect between the two, because Prime Minister Netanyahu came out last week with a video in English complaining about this, and the US seemed quite bemused. They didn't know what he was talking about. There's actually some reports in the Israeli press this morning saying what had happened was the US had been fast-tracking weapons supplies to Israel, and that only lasts for a certain period, and that reflected the intense battlefield activity that was going on. And now, as it's slowed up and that fast track sort of comes to an end, things have gone back to more normal supply periods, and they think that's what Netanyahu is getting at. But it's also interesting that the defence minister is also going to the US, and there's some speculation also that Netanyahu was sort of trying to preempt that he might get some sort of deal done. There's a bit of rivalry between the defence minister and the prime minister. The defence minister has been a bit critical of the failure of the government to provide some sort of plan for where things go with Gaza at the end of the war.
Yeah, the internal politics in Israel getting quite interesting, isn't it? Because we now have a number of tech leaders maybe perhaps showing some political aspirations.
Yeah, they seem fairly keen to try to bring down the government, which there seems to be a growing chorus for as well. Just in terms of they want elections that will reflect where things stand in Israel today. Obviously, there was a huge crisis after October 7. There's been a war. The government is a I wouldn't say a marginal one, but it's relying on some fairly extreme elements there. So they think that Israel needs a reset. There's also talk of some of them going into politics as well. As I mentioned earlier, I don't think that this would worry Netanyahu in the slightest. I mean, these guys are very easily sort of categorised as the elites of the country. Netanyahu has always sort of relied on sort of more working class, more right-wing voters, and they've stuck with him fairly strongly. Its domestic scene's very polarised as well. So whether even if they held it in an early election, the next one's due in 2026 on a normal timetable, if they held a new one, whether it would actually give us a clear resolution of a majority government is quite questionable as well.
Bloomberg editor Michael Heath there. Well, extreme weather events over the weekend, Paul, is one of the sort of stories that we're tracking at the moment.
Yeah, Saudi authorities saying more than 1,300 people have died during this year's Hajj pilgrimage as the kingdom faces extreme high temperatures. The Saudi health minister says most of the victims were what he called unauthorized pilgrims who walked long distances in the heat to perform the Hajj rituals. Almost 700 of the dead are from Egypt. Speaking on state-owned TV, the minister said another 95 were being treated in hospitals. The US mid-Atlantic region is struggling under an extended heat wave. Temperatures soaring from New York to Washington. New York Central Park touched 33 degrees Celsius. Temperatures at Reagan National Airport outside Washington, meanwhile, tied a record set in 1988. And more extreme weather might be on the way, with forecasts for severe thunderstorms and possible tornadoes. More than 40 people have died after heavy rains and floods hit regions of China. State media say 6 people previously reported missing after a landslide in Fujian province have been confirmed dead. A landslide in Hunan province also killed 5 people. President Xi Jinping has called for all-out efforts to address the flooding and assist affected residents. We have more ahead on the Asia trade. This is Bloomberg. You are watching the Asia trade. Let's take a look at the week ahead. Busy week it is. We're really dominated by politics as well. At the end of the week, we do have that snap election in France. That's pretty interesting. The National Rally doing very well. Emmanuel Macron's party in 3rd place. But before that, on Monday, we've got a UK election debate. Of course, Rishi Sunak's Conservatives staring down the barrel of a potential wipeout there. Also, Thursday, the US presidential debate. Going to be interesting for a number of reasons, Heidi. Not only are these always usually very entertaining, but Donald Trump says he's going to announce his running mate then. In pure showbiz style, he's not telling us who it is. So we're left to guess. Okay, so who might it be? North Dakota Governor Doug Burgum. Well, he's got a pretty strong personal relationship with him. The Ohio Senator J.D. Vance, very young, 39. That's refreshing. He's also the author of the well-known book Hillbilly Elegy. And then Florida Senator Marco Rubio, perhaps the most intriguing pick. Well, I think so anyway. It was back in 2016, of course, Trump was referring to Marco Rubio as Little Marco. Marco Rubio responded by saying Trump was the most vulgar person to run for the presidency. It's 2024 now, so none of that matters, does it?
Bygones be bygones, Paul. Yeah. It's a new era as far as political lifelines are concerned, right? You mentioned some of the other elections that we're following. Iran is actually another one, that snap presidential election to take place on June 28th, really dominated by establishment hardliners there. There's only one reformist out of the 6 candidates that are approved to compete in that vote to succeed the late President Ibrahim Raisi there. So watching that, but of course, one of the main events will be the French election. And as you mentioned, these latest polls showing that the French National Rally Party is forging ahead of President Emmanuel Macron. Macron's movement at just 20%, 27% for the New Popular Front Alliance. That's a left-wing group. But Marine Le Pen's far-right party at 36% in this latest survey by LRB. So watching that, and of course, stock traders are already positioning ahead of that and expecting some turmoil to come from the French election. We're seeing a lot of moves when it comes to banks, operators of highways and infrastructure, largely in focus, that $240 billion equity market sell-off. And a lot of those market jitters are growing around the uncertainty when it comes to fiscal policy, the debt outlook, and the funding as well. And as always, we're watching for sort of policy measures out of China as well this week.
Yeah, that's right. A little bit closer to this part of the world, looking at WEF in Dalian, perhaps better known colloquially as the Summer Davos. So 1,600 delegates in attendance there. First day is Tuesday. The Chinese Premier Li Qiang will be there on that day. Topics there include the new global economy, China and the world, entrepreneurship in the age of AI as well. So the two-day WEF gathering in Dalian getting underway this Tuesday, Heidi.
Take a look at our futures in Europe are opening amidst what has been a pretty lackluster start to trading in the Asia session. A little bit more positivity. Euro Stoxx 50 futures up about 0.1%. German DAX futures also positive as well. We've got pretty high-ranking members of the German leadership, including the Vice Chancellor, that have been in Beijing over the weekend for meetings there to talk trade and potentially to talk EU sanctions there as well. We did see European stocks rising for 3 days out of 4 last week. That unexpected rate cut from Switzerland, some of the signs that the UK may soon follow suit, really spurring some optimism. So a lot of those gains last week coming from rate-sensitive tech and real estate stocks. So we're watching those again in this part of the session. But that banking rally potentially is wobbling, threatened largely by the French political risk there. Since that snap election on June 9th, we've seen European banks shares just slumping. They were the top performing sector in Europe for the year on these high margins, hefty dividends. We're seeing, though, a lot of those investors that have once championed the banks now cutting exposure. There's a lot of concern about the sliding value of big holdings in French sovereign debt. We're seeing French bond futures, though, for the session opening high. We're up about 6 ticks at 124.09. And a quick programming note, speaking of the elections, less than 2 weeks until Britain's general election, UK Business and Trade Secretary Kemi Badenoch and the Shadow Business and Trade Secretary Jonathan Reynolds will be joining us in a live televised debate moderated by Francine Lacroix. You can watch it today at 7:30 p.m. Hong Kong time on Bloomberg TV. It's also on the Live Go function on our terminal, on our website, on YouTube and Bloomberg Radio as well. More ahead on the Asia Trade. This is Bloomberg. Let's get some analysis now on China and the European Union agreeing to start talks on the bloc's planned EV tariffs. Let's bring in Deborah Elms as a head of trade policy at the Heinrich Foundation. Deborah, always great to have you to talk all things trade. And it does seem like we're at the precipice of a bit of a moment, right? We're seeing tariffs kind of being flung about as what you say is a normal policy tool. Do you think it's possible to walk back on this, or is it just encouraging that these parties are coming together to the table at all?
I can imagine that they could come back in some way and either eliminate the tariffs or keep them suspended for some period of time, depending on the level of talks. Alternatively, they could be imposed as planned, because the challenge is they're being imposed officially because of subsidies, and those subsidies are not suddenly going to be turned off in the next week, regardless of how well the talks go.
The issue is the issue is that China can't and probably won't change structurally, as you say, the nature of these subsidies and the way that this industrial policy is being prioritised, right?
Right. So, you know, if the issue, which is ostensibly the reason why we are imposing tariffs, is because of subsidies, those subsidies are locked in place for at least some period of time, and they don't simply get turned off overnight. The larger challenge, of course, is not actually about subsidies as much as it is about future competitiveness in a key sector for the European Union and for others. And I think that is a problem that doesn't go away no matter how much time you give it. Frankly, you need a lot of time and effort to try to increase competitiveness if that's the ultimate objective.
Yeah, let's talk a little bit more about that idea of future competitiveness, because if we take Canada, for example, looking at imposing tariffs or measures in line with the EU and US, it imports a vanishingly small number of Chinese-made electric vehicles. It's less than half of what Australia imports, and most of those are Teslas. So how far can you push this potential competitiveness argument when imposing trade barriers?
I think it's a real challenge. It's a challenge to the trading system where at the moment, the rules are structured so that you can't impose barriers until and unless you can show not just that there's a problem, but that it's causing domestic level injury. When there's no imports, it's very hard to argue that there's domestic level injury. So I think this is a real threat to the system, but also the fact that, again, we're talking about future competitiveness. If that becomes the benchmark, we may not have future competitiveness. Where does it stop? So it's not right now currently on electric vehicles, could be on other kinds of green technologies. But in the future, it could be, I don't know what, your potato crisps are a future competitiveness issue, and therefore I impose policies to keep your potato crisps out. I mean, I think this is sort of a slippery slope kind of an argument. And although it sounds a bit overblown, I can see how we morph from a discussion about EVs today to a discussion about a much larger, broader range of products tomorrow.
Is it going to be a discussion, though, or is it going to be an ugly battle? Because, look, if we take, again, Australia as a case study, China got into a trade dispute with Australia. We got a list of 14 grievances, 3 years in the diplomatic deep freeze, a number of trade strikes as well. But when you're dealing with partners the size of the EU, US, and Canada combined, is the playbook for China going to be a bit different this time around?
I'm not sure. I think China might argue that the demonstration has already been made vis-a-vis Australia, so they don't have to do that multiple times. We've already illustrated the power of our market and the way in which we could leverage our market access to harm our partners, or our competitors in this case. And we don't need to do it more than once, or if we do need to do it more than once, at least we know how to get it done. And I think the Chinese threats against European products in particular, pork, luxury goods, alcohol products, is an example of how the Chinese have carefully calibrated and targeted what they think could be a retaliation if the European Union is not prepared to back down on EV tariffs and other issues.
Deborah, you talked about the slippery slope, and we saw how tariffs became a weapon in the last US presidential election and the prior administration, right? Is there a real risk that this is going to be the case again come November and beyond?
Definitely. I mean, we already saw that the Biden administration also increased tariffs. Trump has been talking famously about a 10% across-the-board tariff and 60% against Chinese products. It appears that tariffs have become a tool or a weapon that can be used at will without regard to existing practices. And I think that is very dangerous. That's an extremely dangerous precedent, and it will not just be deployed, I'm afraid, by the U.S. against China. It could be deployed by, members of Southeast Asia against one another even. I mean, if the issue is this is now a legitimate tool of trade, and I'm concerned about future competitiveness, you can imagine how difficult that becomes when the market, which is already feeling very protectionist, starts to use tariffs and future competitiveness as new excuses for imposing restrictions on trade movements.
Deborah, do you think when it comes to EVs, when it comes to products and manufacturing that goes towards a green economy and net zero, that they should be in a different category, if you will, right? Because there's obviously a broader intention to try and get to net zero, and the quickest way to do it and the easiest way to do it is to make things as cheap as possible.
I think it's a real challenge. You know, you have multiple contradictory impulses to stay competitive in a key sector, to transition to net zero, to deal with the geopolitical arguments. All of these go at odds to one another, right? So how do we encourage net zero while we are dealing with competitiveness in a key sector with a geopolitical adversary? That's a challenge. But I think if you're just putting climate at the top of that list, then clearly we need more electric vehicles. We need more green technologies of all kinds. We need more effort to put green technology into the grid system so that we have more access to clean energy sources. That, again, is at risk if we are entering a world in which the geopolitics and the future competition discussions trump our discussions about climate.
In the context of Trump, differently though, we do have a presidential election coming up in November. What's going to be worse for the US-China trade relationship, a Biden presidency or a Trump presidency?
It's unclear to me. I mean, I know people are saying that the first Trump administration was manageable, the guy's transactional, they can come up with a deal, it will be fine. But I don't think Trump in 2025 and beyond is the same person that we saw before, and he's not going to be surrounded by the same set of advisors. So I am deeply worried that a second Trump administration will be much more chaotic. I mean, it was chaotic the first time, but it will be much more chaotic, including towards China, where Trump's own contradictory impulses with regard to China are going to be on full display. And I can imagine, again, that schizophrenic policy of trying to be integrated but also trying to be combative is going to play out in interesting ways. Trump himself is happy to reach into the U.S. toolkit and pull out statutes and regulations that have never been used before. So I think that is a risk, and one that I'm deeply worried about.
Deborah, I'm sure we'll be talking to you at length over the next few months ahead of that. And in the aftermath, Deborah Helms is the head of trade policy at the Heinrich Foundation there. Take a look at how we're faring when it comes to Asian markets, and we are seeing a little bit of a bifurcation, if you will. Japanese markets have actually swung into some gains. In fact, we're seeing just about every sector trading on the topics doing quite well, other than real estate, a little bit more muted when it comes to gains in the Nikkei 225, but healthcare, industrials, as well as some of those consumer names are showing leadership there. Korean stocks are a little bit softer today, and we are seeing some downside when it comes to trading here in Australia as well. Broadly, we've had this sort of quarter and a half year approaching, and investors perhaps looking to lock in some gains after what has been such a strong run for global equities. We've got this week, of course, US data, Fed speak, political risks, a lot of election action going on, so that could really contribute to some strength in the US dollar and potentially further weakness when it comes to the yen as well, despite, of course, more verbal jawboning from the currency chief this morning saying that they can act 24 hours a day if they wish to. Risk reversals, take a look at this chart that we're watching, showing options positionings of yen traders, though, is not really pricing in any big impact from intervention risk. And we've seen really a couple of BOJ decisions, as well as, record amount being dedicated by the Ministry of Finance when it comes to this FX support for the yen. None of those things have really meaningfully moved the dial when it comes to upside momentum for the dollar, Paul.
Well, shares of Mitsubishi Heavy Industries have doubled this year, hitting a record last week on expectations for its energy and defense business. The company's CEO, Seiji Sumizawa, told Bloomberg they've finished designing a next-generation nuclear reactor, paving the way for construction to begin as Japan shifts its energy focus to develop more atomic power. He sat down for an exclusive interview with Sherian in Tokyo to discuss their outlook, including their role in Japan's space ambitions and the rising global demand for energy amid the AI boom.
The annual worldwide power output was recently estimated to be 40 gigawatts. Now, that figure is expected to increase to about 50 gigawatts as the need for data centers grows and AI expands. We are developing a business structure to respond to this increase.
We're still seeing a veering away from fossil fuels. Do you expect that to have an impact on your gas turbine businesses, or can this also be offset, say, by your nuclear business?
I believe that gas turbines will grow going forward, and they will be combined with carbon capture, hydrogen combustion, and so on. Nuclear power is also a valuable power source in the context of carbon neutrality, so I think it will be necessary to a certain extent as well.
You're also Japan's largest defense contractor, and you're developing a stealth fighter jet with companies from the UK and Italy. Do you expect more of such projects given the increasingly complex geopolitical environment?
If necessary, it will be discussed in the context of how to protect the security of allied countries based on the demands of national and regional security. There will first be discussions on what kind of equipment will be needed in the region. It's difficult to speculate on whether there will be more demand in this sector.
You have an upcoming launch of the H3 rocket. How important is your space transport businesses in your broader business complex?
The space segment is not a large part of our business. However, I believe that this is a very important field for Japan. And as a core company in this field, we would like to make a strong commitment to the business.
Mitsubishi Heavy has talked about partial or complete reuse of the H3 rocket. How well do you expect to be able to compete with the reusable rockets from SpaceX?
Reusable rockets will become the focus of research and development in the future. But we're not at the stage of developing anything concrete right now. In the future, we would like to build a rocket that can compete with SpaceX.
You have talked about how important the space projects are for Japan as a country. The National Space Agency, though, has had many setbacks. What do you think is needed in order to move forward these space ambitions?
That is a difficult question. I think it's important to expand the industrial base by increasing the number of launches and to expand the use of constellations and other satellites. It's also important to find a balance between the public and private sectors.
That was Mitsubishi Heavy Industries CEO Seiji Izumisawa. They're speaking exclusively with Sherian in Tokyo. More ahead on the Asia trade. This is Bloomberg.
Right, let's take a look at how US futures are tracking at the moment. S&P E-minis, well, they're up again. That's interesting. Nasdaq futures higher as well. A bit of a mixed bag, though. And in terms of where we head next, the latest MLive Pulse survey shows the S&P 500 is now more overvalued than US credit or gold. And half the respondents expect the next 10% correction to start sometime this year. So let's get to Garfield Reynolds now, who leads our MLive Asia coverage. Garfield, when we look at this big rally that we've seen on the S&P, it does look a little bit lopsided towards big tech, AI-heavy stocks, anything related to that. What sort of correction are survey respondents looking at here?
Well, I mean, survey respondents are tapping into the concerns that have been raised, all the way up, as it were, for this recent rally, which I think you have to say is a bit more than a little bit overly focused on tech. The difficulty is that, investors are looking at the way the US stock market is traveling and going, this looks a lot like the dot-com bubble. Then again, the dot-com bubble, had to go very far indeed before it seriously burst. Many people are thinking that AI could be a game changer even more so than .com. So that makes it difficult to argue that you definitely want to stay away from something that looks like it's got all that momentum. I think investors are looking for it to calm down a bit. They would like it to calm down a bit. Probably there'd be a lot of appreciation if it does have a classic correction, falls 10 to 12% or so from its recent highs, then the buying momentum would come flooding back in. unless the US economy is looking to be in serious trouble, serious enough to potentially get the Fed to not just lower rates once, but more than once this year.
And it does seem like a lot of these markets are primed with investors wanting to pull back and maybe lock in profits going into the second half, right? We're seeing kind of patience being lost with China, patience being lost with Japan at the moment to some extent too.
Yeah, very much the case. I mean, with Japan and China, there are some local issues. China, what's been going on the ground there has not gelled with the optimism that came through earlier this year that the Chinese authorities were taking strong actions to turn the real estate sector around, and that more strong stimulus would be coming to spark a more general turnaround. That hasn't come. We've still got real estate facing problems there. So yeah, that looks a prime example of why you would start taking profits in China, because the momentum, from February has well and truly faded, and as the chart shows so well, we're at that difficult position. Japan also, it's been such a big overperformer, and all of the concerns about what's going on with the yen, that just, gets some investors to go, might be in the too hard basket for now. Let's take some money off the table, reassess going forward.
Garfield Reynolds, who leads our MLive Asia coverage. We're staying with China, and Kaiser Group returns to court today in Hong Kong, one of a string of defaulted developers facing liquidation hearings this week. Let's bring our Bloomberg bond and loan reporter Loretta Chen, who joins us in Hong Kong. So, Loretta, what are we expecting?
So this is several times Kaiser has faced liquidation hearings in Hong Kong court. This is at least the third time that they're doing this today. And we're expecting to hear that the company present a more concrete plan on how it's planning to restructure its $12 billion debt in the offshore market. So last week, we heard from Reuters that the Kaiser chairman has already gone to Shenzhen to seek regulatory approval for its restructuring plan. So this tends to be, one of the signals that companies' restructuring plans are coming into shape. So that sounds like good news. So we're expecting that the company can actually present something concrete to defend its case in order to fend off that potential liquidation in Hong Kong court.
All right, well, that's Kaiser, but there's 4 developers that are facing liquidation hearings. What else is coming?
Yeah, so this is a busy week in the Hong Kong court for developers. There are 4 companies, 4 Chinese developers that are facing liquidation hearing. Today we have Kaiser and Dafa, and Kaiser will be the first case to be heard at 9:30. And then on Wednesday we have Shimao Group, which is also a very iconic developer that's facing distress in the property sector, and also Redsun Properties. So these 4 are going to be heard this week, and over the past couple months, we already had, a dozen developers that are facing similar situations. A few weeks ago, we had a small developer, Desing Properties, actually been ordered to liquidate by Hong Kong court. So some of these developers, it's not the first time that they're doing this. So the risks of them, potentially facing that liquidation order is getting higher if they cannot show enough proof that they can do the restructuring orderly with their creditors.
All right, Bloomberg bond and loan reporter Loretta Chen there in Hong Kong. More ahead on the Asia trade. This is Bloomberg. This is the Asia trade, the latest from the corporate front. Australian supermarkets, including Woolworths and Coles, will face potential multi-million-dollar fines for anti-competitive behaviour under new regulations. And that's amid a government crackdown on unfair prices and the rising cost of living. The new measures follow a review of the industry's code of conduct, which found that large supermarkets hold too much power over suppliers and farmers. US prosecutors have recommended to senior Justice Department officials that Boeing face criminal charges for violating a settlement related to 2 fatal crashes. This is according to Reuters, citing 2 people familiar with the matter. The criminal charges DOJ officials are considering weren't specified and could extend beyond the original 2021 fraud conspiracy charge. Haidi.
Take a look at how US futures are trading at the moment. We're seeing a little bit of uptick there when it comes to S&P futures. We're seeing some of the tech names trading a little bit higher there as well, but it is looking a bit more lackluster going into the start of trading in Greater China, and also Taiwan. TAIEX futures there down by just about 1%. We are seeing, as we spoke a little bit earlier about, just the loss of patience by investors looking at poor performance out of China, and we are starting to see again that sort of rotation of outflows there for Chinese equities, despite some of the inflows coming through potentially from reallocation out of the Japan rally. This is a picture, though, as we look at FTSE China A50, I should say, China futures looking pretty flat at the moment. We're seeing a number of these markets where investors might just be trying to kind of lock in some gains after what's been such a strong run this week.
Yeah, let's take a look at how commodities are tracking at the moment. We're seeing a little bit of softness in oil prices. The dynamic there is quite interesting because we are still seeing tension in the Middle East. 2 ships have been attacked near Yemen recently. Iron ore prices holding firm. Copper's an interesting one, though. Kind of caught between 2 forces here. The expectation that copper demand will surge on AI, but reluctance from Chinese buyers to enter the market. Well, that is it from the Asia trade. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The China show up next. This is Bloomberg.